Hello, I'm Greg Hunter. Thank you for joining us today on USAWatchdog.com. Today's guest, James Rickards. He is a partner at JAC Capital Advisors. He is an insider. He knows all about Wall Street and investment banking. James Rickards, thanks for being on USAWatchdog.com. I want to talk to you about this Libor scandal, which is a giant fraud. Do people realize how big of a problem this is for the global community?
I don't think so, Greg. I think relatively few people realize it for a couple of reasons. Number one, look, Libor is technical. If you're a banker or you're a swaps trader, obviously you understand what it is, but everyday Americans certainly don't. It's something they've never heard of. And number two, to the extent that it sank in at all, there was this notion that the banks were manipulating Libor downward. So if your mortgage was based on Libor, your car loan was based on Libor, and they lowered the rate, that seems like a good thing to you. So I've spoken to people on Capitol Hill, and they said, look, the members' phones are not ringing off the hook because the story's been put out there that mortgagors, if you have a mortgage, you were not disadvantaged because they actually lowered the rate. So that's just sort of superficial level. But behind the scenes, this is, I think, the greatest fraud and the greatest potential liability for the banking industry in history, simply because of the sheer volume of it. Let's forget about the mortgage market for a second. Let's go over to the swaps market, the derivatives market. Derivatives, right? Every derivative is a two-sided trade, and they're basically bets. So I could enter into a swap with you. It could be a swap on, the S&P 500, the Dow Jones Industrials, Greek default. It could be on a lot of things. And so I make a bet with you. I say, look, Greg, you're going to pay me if the Dow Jones goes up. You're going to pay me if the S&P goes up. You're going to pay me if Greece defaults. But the other side of the trade is I have to pay you Libor. That's half of every swap. And so there are $500 trillion worth of swaps in the world, possibly more. It's an opaque market, but a lot of sources have made it clear it's at least that much, according to the Bank for International Settlements. So if you take even a very small difference, let's just say 10 basis points, you apply 10 basis points to $500 trillion times 5 years, because that's how long the fraud went on. Potential damages are $2.5 trillion, not billion, trillion. That's greater than the combined capital of all the too big to fail banks in the United States. In other words, forget about the regulators, forget about the penalties and fines. When the class action lawyers get a hold of this, and they already have, these class action lawsuits have started, you apply normal measures of damages, you very quickly get not to the tens of billions, but to the trillions. I think it's so bad that Congress will probably have to intervene and put a cap on damages, in effect bailing out the banking system once again, because if you let these lawsuits run, they're going to destroy the banks. Now, more recently, it's been reported that this is not only a banking problem, it may be a hedge fund problem, because a lot of the guys who were conducting the fraud inside the banks left the banks and joined hedge funds. Who knows what kind of inside information might have been passed back and forth. But now some of those hedge funds are going to be on the line of fire. This is huge. It's very hard to get your mind around like 500 trillion. We all know it's a big number. When you do the math, the potential damages could destroy the banking system.
Oh, wow. I said if they had to pay for 0.1% of the $800 trillion in transactions, that would be $800 billion. And you're saying 2.5 trillion based on 10 basis points, 0.1%, basically, right?
Well, right, Greg. But the difference between my calculation and yours is you're doing it for 1 year. I'm saying this fraud went on for 5 years.
Oh, yes.
So take your number and multiply by 5, and you get up to the trillions.
You're correct. You're correct. Tim Geithner, he says that, when he was at the New York Fed, he basically made recommendations to the Bank of England. They tried to do something. Did they really try to do something? Isn't he on the hook? Isn't he in trouble?
I think I think he aided and abetted the crime. I don't know what the Bank of England, so I guess we do know what the Bank of England, they did nothing. Mervyn King requested that the so-called club of central bankers that they meet for dinner on September 9th in Europe to talk this over. Well, they wouldn't be meeting to talk it over if they had solved the problem, because clearly the problem still exists. But the point is, look, if you see a crime, you don't send an email saying, I really encourage you to stop the crime. You call the cops. Why does Geithner call the Bank of England? He should have called the FBI. you should have called the Department of Justice. This is a fraud. Or maybe, even if you think it's civil, call the SEC, call somebody with enforcement power. You don't send an email to another central bank, you call the cops. And so once you don't do that, when you see the crime and you don't do anything about it, and you don't notify the authorities, you're now in effect a party to the crime. You're aiding and abetting the crime. So I think Geithner has, serious potential criminal liability. I don't think it will come to that because I think, look, he's part of the administration. The administration controls the Department of Justice. They have no appetite for this. They're not going to prosecute Geithner, and the Department of Justice has no appetite for prosecuting banks because the consequences of that are too horrendous. But you have to call it like you see it. I think too big to fail has turned into too big to jail. In other words, these guys are really outside the legal system. They can do whatever they want because they work in institutions that cannot come under legal attack.
Aren't we going to take a hit anyway? I mean, I know the prevailing idea is, well, let's not make the banks go under, let's limit liability, or let's not prosecute them for crime or whatever. But that just puts it off. Aren't we headed for a crash?
Well, the potential for a crash is always there. It's there today. It'll be there tomorrow. That's not going away. It's very difficult to predict the exact moment of a crash. My analytical method is basically to look at systemic forces and systemic dynamics to understand the risks that are embedded in the system. My metaphor, but it's more than a metaphor because the science and the mathematics are very similar, would be an avalanche. Avalanches don't happen every day. What happens is the snow, it builds up, it builds up, it builds up, it builds up, and at some point it becomes dynamically unstable, and one little snowflake lands and it spreads a little bit, starts something bigger, and then the forces begin to cascade, and the avalanche comes and falls down the mountain and breaks the village. Now, in that situation, do you blame the snowflake, or do you blame the instability in the mountainside? My point is, if it's not one snowflake, it will be another. The real danger is the instability in the mountainside. So what I would say is, we've created that snowpack. We've created a very, very unstable system, but it's hard to say exactly what thing will trigger a collapse. But yes, there's a definite danger there.
Let's talk about QE3, or you recently were on another channel you were talking about. This time, QE is going to be, your words, open-ended. What does that mean?
Well, what it means is that QE is just printing money. So basically, you buy government securities, or buy actually any kind of securities. They can buy government securities, but the Fed can buy mortgages, which they have. But the Fed can buy anything. The Fed can buy stocks. They can buy commodities. People don't realize that they can kind of go out there and buy anything they want. They have that legal authority. But whenever you buy it, you do it with printed money, and this is how the Fed expands the money supply. Now, I think the mistake that they made in QE2, they announced QE2. They kind of pre-announced it in August of 2010 at the Jackson Hole meeting hosted by the Reserve Bank of Kansas City. But they said, we're going to buy $600 billion of intermediate-term treasuries before the end of June 2011. So they gave a quantity, a security type, and a date. Well, markets are discounting mechanisms. Markets take information, and they discount it immediately. Now, the stock market rallied on that news in September and October 2010. You had a pretty good stock market rally because of the Fed's announcement. But by March 2011, the market was looking at the end of QE2, which was over June 30th, 2011, and saying, hey, what else have you got? We know what you're doing. The market, all the pop came on the front end, but by the middle of it, the program was no longer effective because the markets were saying, okay, we understand that. We've priced that in. Even though you haven't finished buying the bonds yet, we, the markets, have priced it in. What else have you got? And so the Fed sort of painted themselves in the corner by putting specific dates and amounts on it because, again, the market discounted that. So I think what they'll do the next time is they'll actually use a phrase, something like nominal GDP targeting. It sounds geeky, but all they're really saying is, the debt is nominal, so therefore we need nominal growth. Nominal growth is just the sum of inflation plus real growth. The Fed would love low inflation and high real growth, but they'll take high inflation and low real growth if that's what it takes. If that's the best they can get, they'll take it because they need that nominal growth to pay off the nominal debt. And so when the Fed says something like nominal GDP targeting, what they're really saying is they don't care about inflation anymore. I mean, they do, but they're willing to accept more inflation. So that's sort of a signal for inflation. But what it means to the market is we're going to do whatever it takes. We're going to buy securities. We're going to keep buying securities. We're going to do it for years if necessary. We'll do whatever we want in terms of security types and quantities, whatever it takes to get nominal GDP going up. So they're going to avoid that trap of giving the market some target to hit at. See, at that point, the market no longer has no longer knows exactly what the Fed is going to do. They're just saying, hey, these guys are going to print money until the cows come home. And so you will see asset values go up and probably inflation figure up, and that's what the Fed wants.
When do you think they're going to throw the towel in on inflation and announce the open-ended QE?
Well, obviously, what the chairman has said is they're going to look at data. They're going to be very influenced by, the unemployment report. But, even today we had another bad initial claims report. It was much higher than expectations. That's another data point in a long series, really a 3-month series at this point, where the data just seems to keep getting worse and worse. And this is just an estimate on my part, so it's not as if I'm submitting this. And I do what I call the Jackson Hole two-step, where they announce something at Jackson Hole at the end of August, but they don't actually buy the bonds until after the election. It's sort of a pre-announcement, which, by the way, is what they did in 2010. Now, there you sort of have the best of both worlds, because the announcement alone is enough to get the stock market up, but if you don't actually buy the bonds until after the election, you insulate yourself politically. People will say, oh, you're printing money to help Obama, and the Fed will say, no, we're not. Because we're not actually buying the bonds until after the election. So you may see an announcement in August and actual bond purchases in the fourth quarter.
And final question, what does that do to gold, silver, farming commodities? They have big drought out in the Midwest. Just that alone is going to drive up prices. What does that do to commodities?
Well, it's bullish for commodities. It's certainly bullish for gold, and I think you're going to see agricultural prices go up on 2 vectors, inflation and the drought. So I think you're right about that. But for most other commodities, you have to be a little bit careful because there are multiple drivers. One is inflation, which we just talked about, but the other one is industrial demand. I mean, things like copper, iron ore, bauxite, many others. These are driven by industrial demand for steel and aluminum and, in the case of coal, energy, et cetera. And so if you have industrial utilization dropping, that actually might weaken some of those commodity prices. Gold is different. Gold has almost no industrial applications. It's a pure monetary metal. In my view, it is money. I don't think of gold as an investment. I don't think of gold as a commodity. I think of it as money. And when people say gold's going up, I just think, well, no, gold's not going up. The dollar's going down. That's what the gold price is telling you. But sure, more money printing at the margin will be bullish for gold. And I think the drought also will push commodity prices up, food prices in particular. The combination of the two will tend to be inflationary. But remember, that's what the Fed wants. The Fed spent 30 years telling us inflation was bad, we're going to crush inflation. And they did. So today, everyone has it very much ingrained in their heads, the Fed's against inflation. That's not true anymore. The Fed wants inflation. That's the only way out of the debt problem.
I said there was one last question. What do you think gold will be, at the end of 2013? What price? Ballpark?
It's very hard to say because gold is very volatile and it drives a number of vectors. I feel more confident saying there's a floor under gold than picking out a target price. So in the 3 to 5 year time frame, I continue to think gold will be in the $5,000 to $7,000 range because that's where it has to be, based on the amount of printed money. If you think that printed money has a life of independent of gold, then fine, but I don't. I think there is always some relationship. It can get out of whack for short periods of time, but at the end of the day, that relationship is going to be reestablished. And just based on the physical supply of gold and paper money in the world, that implies the price, it varies, but $5,000 to $7,000 per ounce is a reasonable range. But that's more over 3 to 5 years. In terms of the end of 2013, I feel more confident saying there's a floor under the mark, a floor of around $1,500 an ounce, because of the Chinese bid. The Chinese are acquiring as much gold as they can, as fast as they can, but they're smart. They don't want to be the dumb money. They don't want to run the price up. They don't want to show their hand. So what they do is they tend to buy the dip. So every time gold gets a little bit weaker, here comes a Chinese bid at $1,500 an ounce. So I think the Chinese put a floor under the market. Hard to say how high it will go, but it's a nice bet because it's asymmetric. You have a lot of upside if it goes higher. Ultimately, it's going to go a lot higher. But I think the floor, because the Chinese, so it's a good time to buy now, and it's a nice bet because you have a lot of upside and not as much downside.
Jim Rickards at JAC Capital Advisors. And don't forget his best-selling book, Currency Wars. James, thanks for being on USAWatchdog.com.